Welcome, everybody. This is the part 2 of our monetary policy research program. And today we're going to have two teams presenting, the European Central Bank team and the Bank of England team on monetary policy decisions. We're going to analyze how monetary policy committees look at information, specifically economic information, in order to make efficient decisions on interest rates and other monetary policy tools in order to conduct monetary policy. The first team that's going to present is the European Central Bank, and I pass over to them.
Thanks, Roberto. Good morning, everyone. Thanks for joining us this early hour. So just to follow up on what Roberto said, we're going to start by reviewing how the European Central Bank makes decisions based on various factors such as growth, inflation, and other secondary factors such as industrial output. One of our team members is missing, so wasn't able to make this particular project. So this will be slightly shorter than the average project, perhaps. But the two remaining team members, Annie and Perder, have put in an absolute fantastic amount of work, and I'm really looking forward to. Well, I've already seen their project. I think it's really good, and hopefully you'll enjoy it as well. So I'll hand over to Perder now.
Thank you. So when making monetary policy decisions, the Governing Council of the ECB aims for price stability and economic growth within the Eurozone. And in order to do this and to track their progress, they analyze indicators such as the HCPI and real GDP. Now, as established in the treaties on the functioning of the ECB, price stability and hence low inflation is its primary objective before it proceeds to look at other considerations. So firstly, inflation and price stability. In order to track the progress on price stability, they examined the HICP, or the Harmonized Index of Consumer Prices. Now, the HICP is very similar to CPI, or the Consumer Price Index, but it's harmonized to account for the structure of the Eurozone. Now, it's similar to CPI in the sense that it's a Las Vegas price index. So they define a basket of goods and services for a representative household, and then track the changes in the price of that basket relative to a base year. Now, products within the basket is subject to change. So, for example, 20 years ago, of course, we didn't have any iPhones and other cool technologies which we have today. And so 20 years ago, they wouldn't have constituted part of the basket, but today they do. And so the basket is subject to change. The basket will also soon include accommodation costs following the Governing Council's strategy review this year. Now, it's harmonized to account for different countries, accounting for different total consumption expenditure within the Eurozone. So in practice, what this means is categories in the basket is the same for all countries, but products within the categories may differ. So for example, wine in France may constitute a larger share of the alcohol and tobacco category for France than in Belgium, maybe. Now, HICPs aim to be below or close to 2%, and from there they can pursue other objectives. Now, the Governing Council also considers money supply measures because it provides useful information on future inflation. Now, there's three measures for money supply, M1, M2, and M3. Now, M1 is the amount of currency in circulation and the amount of overnight deposits. M2 is M1 added with deposits with maturity of up to 2 years and deposits redeemable at notice of up to 3 months. Now, while M3 is M2 added with repurchase agreements, money market fund shares, and debt securities with maturities of up to 2 years. Now, next is output and growth. So the Governing Council tracks the progress on output and growth by looking at real GDP, which measures the growth in living standards. Now, in order to calculate real GDP, they firstly calculate nominal GDP, which is the sum of total goods and services consumed by households in the Eurozone for a given period of time. However, alone, this is not good enough because it doesn't consider changes in the price level. So they then go and discount nominal GDP by the rate of inflation, and hence they measure the change in consumption, keeping price levels constant. The Governing Council also looks at short-term business indicators, such as new industrial orders. Now, new industrial orders estimates the amount of orders received by businesses in a given time period for a variety of industries. Now, they look at this because it's very good at anticipating turning points in the business cycle. Next, Annie.
Thank you. So I'm gonna be talking about the decision-making process of the ECB. So before I talk about that, I'm just gonna give a recap of the ECB mandate. So as price stability, so by keeping inflation below but close to 2% over the medium term. So just a reminder that there is no dual mandate for the ECB. So it's just price stability. So I'm now going to give an overview of the decision-making process. So firstly, the ECB uses the full set of information to perform analysis. And in the end, the Governing Council, based on that analysis, the Governing Council makes monetary policy decisions to achieve its objective, which is price stability. So now I'm going to move on to the analysis. So yeah, next slide, please. So I'm first going to look at so this analysis is based on the October 2021 meeting. So I'm firstly going to talk about inflation. So current inflation in the Eurozone is 3.4%. So this is up from 3% in August. So this is largely due to an increase in energy prices, supply chain disruptions, and Germany's decrease in VAT. So however, inflation is expected to decline in the next few years. So it is expected to be 1.7 and 1.5% for 2022 and 2023 respectively. Though this is lower, these rates were revised upwards by 0.4 percentage points. We then look at the 5-year inflation expectations. So this is at, currently at 1.7%. So as you can see, this is below the target of 2%. So with this in mind, with this deviation in mind, the Governing Council felt that monetary policy needs to remain expansionary. So we then move on to economic analysis. So firstly, we look at, on the previous slide. Yeah, there we go. So firstly, economic growth is at 2.2% in Q2. So this is 0.8% above the predicted value. This is mainly due to consumer demand rising and with most activities slowly returning back to normal due to because of the lifting of restrictions. Unemployment rate has also fell back to the pre-pandemic level at 7.3%. However, just bear in mind that there's still uncertainties. So firstly, growth rate still has not reached pre-crisis level, and and there is also employment is also less than the pre-pandemic level because so 2 million fewer people are employed than at the start of the pandemic. And more importantly, with the presence of the Omicron variant now, because of this, in the coming weeks and months, restrictions may be reimposed in certain countries, and this will lead to a slowdown in economic activity. So therefore, with these analysis in mind, there is room for some normalization in monetary policy due to the improvement in economic performance currently. However, due to the uncertainties, there still needs to monetary policy still needs to remain accommodative to respond to these uncertainties. So next slide, please. So with this in mind, what decisions did the Governing Council make? So on October the 28th, 2021, the Governing Council confirmed its monetary policy decisions on the following measures. So firstly, key interest rates. The interest rate on the main refinancing operations, marginal lending facility and deposit facility remain at 0%, 0.25% and negative 0.5% respectively. And this remained the same as the previous round to achieve the 2% inflation target in the medium term. And the ECB announced that they will keep these rates at this level or even further decrease them until the target of 2% is achieved. So we then look at quantitative easing. So there are two branches to this. So firstly, the asset purchase program, the APP. So this will continue at a monthly pace of 20 billion euros. And this is expected to run as long as possible to keep the monetary policy accommodative. So due to the uncertainties I mentioned previously, and this will only be reduced once the interest rates are raised. So we then look at the Pandemic Emergency Purchase Program, which is the PEPP. So the Governing Council will continue to conduct net asset purchases under the PEPP with a total envelope of 1,850 billion euros. And this is expected to end, according to Christine Lagarde in the press conference. This will expected to end at the end of March 2022. However, this is subject to changes. However, what is interesting is the pace of purchase is lower compared to Q2 and Q3 this year. So this gradual reduction in the pace is in line with the assessment of the improvement of the economy and also the slight revision upwards in inflation expectations. However, the Governing Council did make it clear that this did not imply tapering or an end to the asset purchases under PEPP, and yeah, they will still purchase flexibly in order to ensure financial conditions are not tightened, that lending from banks to firms and households are still going on, and more importantly, to prevent the ECB from missing its inflation target. So finally, the Governing Council will continue to provide liquidity through its refinancing operations. So this is to support bank lending to firms and households. Currently, lending to households are slowly increasing. However, lending to firms are still quite low. So yeah, this liquidity provision still goes on. So overall, the Governing Council emphasized that it is ready to adjust its instruments to keep inflation stable at 2% over the medium term. And flexibility is important in this case, since there are still uncertainties present, especially with the existence of the Omicron variant, and this which could impact the economy. Therefore, it is important for the ECB to keep its monetary policy flexible and respond in all ways to achieve its inflation target. So yeah, that is the end of our presentation. So we're happy to take any questions as well.
Thank you so much for your presentation. Are there any questions on the floor? Just raise your hand. No. No? I want to ask you, and this is, there's no fundamental right answer. It's just a question I'm curious from. Out of the information you've seen and the behavior of the European Central Bank in previous monetary policy decisions, would you think the ECB is biased towards having a lower value of inflation rather than higher inflation than expected? Do you think it's asymmetric in a way it approaches inflation, or do you think the loss from, like, do you think the way it perceives inflation higher than expected or lower than expected is pretty much the same? Because I get a feeling that it prefers to have inflation lower than expected than I had higher than expected, but I could be wrong.
Happy to answer this. So if you look historically, the German influence has been fairly strong, and they tend to be more hawkish. However, I think that influence is starting to decrease. I think the head of the Bundestag resigned sometime in the past year because he felt the programs that the ECB was running was too dovish. So I think that influence is leaving, and as such, it's becoming more and more symmetric.
Yeah, just to add on that, if you compare the, okay, maybe the later group will talk about this, but if you compare the ECB's current monetary policy with other central banks' monetary policies, such as the Fed or the Bank of England, they are now pursuing a more expansionary monetary policy compared to the other two central banks, despite the current increase in short-term inflation. So therefore, this kind of suggests that the ECB is getting more like dovish with its monetary policies.
Yeah, I was
Thank you.
actually just back. Oh, yeah, sorry.
I know, sorry if you want to comment.
No, to be honest, I'd just be repeating a lot what Peredur and Annie already said. But yeah, so basically, the ECB was designed in the mold of the original German Bundesbank in the 1990s, which definitely had a very or rather very strong anti-inflation bias. And given that the ECB's founding treaties mean that it has an obligation to prioritize price stability over other objectives. In practice, ECB presidents have tended to prioritize inflation over other policies even more informally. So as the guy said, that has changed from, say, the Trichet era, and Draghi became much more dovish in his tolerance of higher inflation, and Lagarde even more so. But I would say even today, by the standard of other central banks, yes, the ECB would definitely have a below target policy bias.
Thank you so much. I think that was a nice discussion. Are there any other questions? If not, we thank you so much for the presentation, and we'll move forward to the Bank of England presentation for today.
Yep, sure. Mason isn't here
Who's
today,
gonna?
so I'll
Yes.
be sharing the screen. So can you make me the co-host, please?
Perfect. I think you can share them already. Try if you can't.
Okay, yeah, I can. Give me a moment.
Wonderful. For the audience, Mason, the head of the Bank of England team, couldn't attend today, so it'll be a great opportunity for the analysts to take over and present their findings.
Okay, so before we start, I'll give a short introduction. So hi, my name is Andy from the Bank of England team, and with me today will be Sana and Shahan. So we'll be presenting on the BOE's monetary policy report, and I think it's largely based on the latest report, which was just out in November. So we hope this presentation will be informative. And with that, Sana, could you start? Thank you.
Okay, so we're going to start off by looking at the information set the MPC considers before making monetary policy decisions. So the members look more broadly at the international economy, monetary and financial conditions, demand and output of various services, and the supply, costs, and prices. And more specifically, the indicators the MPC members look at include GDP projections, the labour force survey, and the CPI inflation. Next slide, please. So the MPC considers it important to understand the impact of foreign developments such as FX rates, net exports, and inflation as their key determinants of inflation. So for example, through trade channels, UK exports could be impacted if a trading partner's economy is experiencing a downturn, which would reduce demand for UK exports, thereby resulting in deflationary pressure. Alternatively, if there's a depreciation in the pound, imports become more expensive and exports become cheaper, which results in imported inflation. And it's also important for the MPC members to know the leverage ratio of commercial banks. So the leverage ratio is the ratio of a measure of a bank's capital resources to its gross measure of its exposure or assets. And knowledge of the leverage ratio is important because if there's excessive leverage known as debt overhang, it prevents firms from borrowing money from banks to finance investment. And this results in underinvestment and misallocation of resources, which has chain effects on economic activity and unemployment rates. And it's also important for MPC members to control the money supply because, for instance, an increase in money supply lowers the interest rates, which encourages investment and spending, thereby having a large impact on economic activity. And additionally, during the expansion and boom phases of a business cycle, stock market prices are likely to rise and firms issue equity and debt. Therefore, if money supply continues to rise and expand, then the public begin to expect inflation and the MPC will have to implement monetary policy to respond accordingly. So the MPC's role is to keep inflation at its target, but it also supports the government's broader economic policies, including economic growth, which is reflected through GDP. So by examining the current levels of output, estimations can be made about the output gap, therefore the policies that are needed to raise the level of aggregate demand in the economy. And the Bank of England defines GDP as a measure of the size and health of a country's economy over a period of time. And there are three ways that GDP can be calculated. So the total value of goods and services produced, everyone's income, or spending by everyone in the country. And currently, the UK GDP increased in Q3 this year, but at a slower pace than projected in the August report. So in order to make policy decisions effectively, the MPC needs to consider what inflation and growth are likely to look like in the economy in the coming years. Therefore, the capacity of goods is explored through the quantity of labor and capital available in the economy, the productivity of workers, and the efficiency with which businesses combine them. And if the impact of supply chain disruptions on CPI inflation is only short-lived, then implementing monetary policy would only increase the volatility, and by the time the policy takes effect, the impact of the disruption is likely to have faded. However, if the disruption is more persistent, then central banks can tighten or ease the bank rate. So, for example, if there are supply bottlenecks, then to keep supply growing, it's important to encourage capital spending by easing and tightening the bank rate at the right time and speed to encourage investment, but not to choke demand. And the labour force survey is used to measure the unemployment in the economy. And the survey is carried out with 44,000 households being surveyed. And recently, the LFS unemployment rate fell to 4.5% in the 3 months to August, but initial indicators suggested that the unemployment rate will rise in Q4 this year. And finally, CPI inflation is a measure of the price level in the economy, and it is defined by the OECD as the change in the price of a basket of goods and services that are typically purchased by a specific group of households. And the inflation target is set at 2% in the medium term. However, CPI inflation in September was 3.1% and is expected to peak to 5% around April 2022.
So in terms of their decision-making process, the MPC makes monetary policy decisions with the intention of fulfilling its mandates of meeting the 2% inflation target, as well as maintaining economic growth and employment. The Bank of England's analysis says that the reason that their predictions of UK as well as global GDP growth were lower than expected were due to supply chain disruptions. And there were also supply shortages in a few sectors due to increased global demand. They also predict that the supply bottlenecks will limit growth in the short term, but there will be a strong UK and worldwide recovery in early Q1 2022. So this is shown when they say UK GDP is projected to get back to its 2019 Q4 level in 2022 Q1. In Q3, the unemployment rate fell to 4.5%, which is still higher than pre-COVID rates. And the Bank of England expects that it will increase slightly in Q4 2021, which is still an acceptable view. It is still an acceptable level in their eyes, and it's projected to remain between 4 and 4.5% until 2024. Next slide, please. In terms of their inflation mandate in Q3 2021, the rate fell by 0.1% to 3.1%. It's then expected to rise to 4.5% this month and then remain at similar levels through to the end of Q1 2022, then peak at around 5% in April 2022. And the MPC expects that it'll fall back to near 2% levels within the next 24 months. And these projections for the inflation rate in the next 18 months or so are pretty evidently far off the Bank of England's mandated 2% rate. And they argue that the unprecedented supply and demand shocks due to COVID necessitates this deviation from the target, and that they will always focus on the medium-term prospects for inflation, including medium-term expectations rather than factors that are likely to be transient. And this led them to take the decision to maintain looser monetary policy, which will be discussed further by Andy in final decisions. So just to give a few samples of evidence of their decision-making process, they said that energy prices will play a significant role in expected pickup than expected decline in inflation. They also have confidence in their current predictions on price levels. And there's also a feeling of uncertainty on the effect of the end of furlough and the effect of that on unemployment. And also they expect that the labor force participation rate will decrease partly due to COVID.
Okay, so my teammates have covered information set and the decision-making process. In this section, I'll be covering final decisions. So 2 questions to be answered. Firstly, what policy actions did the MPC decide on? And secondly, what intended outcomes did the MPC think these policy actions would achieve? So according to the November 2021 Monetary Policy Report, the MPC decided on 3 main policy actions, which is shown on the slide. Firstly, the MPC voted 7-2 in favor of maintaining the bank rate at 0.1%. Secondly, the MPC voted unanimously in favor of the BOE maintaining the stock of sterling non-financial grade corporate bond purchases at £20 billion. And thirdly, the MPC voted 6-3 in favor of the BOE continuing with its existing program of UK government bond purchases, maintaining the target for the stock of these purchases at £875 billion. So in short, as what Shahan mentioned just now, the MPC decided to maintain their current course of loose monetary policy. According to the report, the MPC judged that the existing stance of loose monetary policy remained fairly appropriate. And from their meeting minutes, you can see that the 7 members of the MPC that voted in favor of maintaining the bank rate at 0.1% wanted to observe the effect of the end of the furlough scheme on unemployment before deciding whether a rate rise was needed. Hence, we can see that labor market uncertainty appears to be the main rationale behind the MPC's decision to keep monetary policy unchanged. Unfortunately for us, the November report did not actually state explicitly the purpose of loose monetary policy, presumably because the intent remained fairly unchanged and they just didn't want to repeat it. So for that, we have to infer it by referring to earlier reports. To provide some context, the bank rate was lowered from 0.75% to 0.1% on 19 March 2020 in response to the economic impact of the COVID-19 pandemic and has since been maintained at 0.1%. The BOE also implemented quantitative easing by the purchase of bonds, which includes both corporate bonds and UK government bonds. According to the May 2020 Monetary Policy Report, monetary policy was aimed at supporting businesses and households through the crisis and limiting any lasting damage to the economy. Monetary policy loosening will bolster cash flows, help maintain the flow of credit, and support asset prices. This to mitigate the tightening of financial conditions that could amplify the initial contraction in activity and help ensure that financial conditions supported economic recovery. In addition, loose monetary policy aimed to limit longer-term damage to the economy inflicted by hysteresis effects, which could arise from business failures and an increase in unemployment. So in conclusion, it is likely that the MPC decided to keep the monetary policy fairly loose to support economic recovery from the COVID-19 pandemic and viewed that it was currently premature to tighten monetary policy due to labor market uncertainty following the end of the furlough scheme. And we have now come to the end of our presentation. Thank you very much for your attention.
Thank you so much for this presentation. Are there any questions in the floor? Kieran, can you mute yourself and ask your question?
Thanks for the presentation, guys. I was just wondering, has Brexit continued to play and the potential hits to inflation and growth that caused, is that still playing a role in the Bank of England's decisions, or has that largely faded from view at this point?
Actually, I'm not too sure. I think they did mention it in the report, but the main focus was still the labor market uncertainty due to the furlough scheme? Because I presume that Brexit has taken place like quite a while back, so it's probably not the main consideration at this point in time for the decision to continue the current track of loose monetary policy. But you guys have anything to add on? Shahan and Sana?
Yeah, I think in this report they didn't seem to mention Brexit, but I think it's because I presume the effects have kind of already manifested, and they seem to have mentioned it a lot in their 2019 reports.
Yeah, basically the same as the other two guys. So.
I have an additional question, if you don't mind. I don't know if Karen still has a question because she has the hand raised. Okay, I have an additional question. Suppose for a second that you three would be the MPC of the United Kingdom. And you've seen that inflation is a bit overshoot. It's estimated to be between 5 and even low 5 point something %. And the Omicron variant has arrived to the UK, which could imply more lockdowns in the future. How would you make a decision on whether to loosen or tighten monetary policy individually? How would you think about it? Do you think it is time to loosen monetary policy and because to restart economic dynamics, or do you think it's better to tighten it because of the high inflation?
Personally, in my opinion, I think it'd be too early to tighten monetary policy with the Omicron variant, because as you mentioned, the appearance of this new variant might induce another lockdown, and with it like severe contraction of economic activity. So there might be further shocks to the economy if we compound that by tightening monetary policy and increasing interest rates and whatnot. That's my view. I'm not sure about the other two.
Yeah, I agree as well, because like he said, it's still quite early on and we don't even know, like we can't be certain whether like the impact will be short-lived or long-lived, so maybe wait a bit longer before we decide.
Yeah, I think if there were definitely to be more lockdowns with the variant, I think I would do the same and just have to maintain the current state just for longer and hope that the effects don't kind of compound, as Andy said.
Fair enough. I think you acted in a similar way to the actual NPC, so that's good to hear. Are there any other questions? Well, if not, thank you so much for your presentation. Both of your presentations were very good. I'm very happy. And the next stage, I think you know this, but I'm just gonna say it as a reminder. The next stage will be a debate we're going to organize on different topics related to unconventional monetary policy, in particular on QE, on negative interest rates, on the famous or infamous MMT. But you don't have to worry about this. At the moment, you'll hear more about this in the Lent term. In fact, I think the brief for this is going to be very early in the Lent term instead of the Michaelmas. So for the time being, have a really good Christmas, a really good break. And yeah, I think that's all. But thank you very much for attending, and thank you so much for the people who presented. I'm gonna end the recording now.